Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, sit tight. You're in for a great show this week. Lots of data to digest. I am super excited to dig into this one. And yes, I am caffeinated, but I've only had one cup so far. But hey, you're in the right place if you want the data. Not the crazy, confusing headlines, but the data, the tips, the tricks, the strategies, the answers to all your questions, so you can go out and make better real estate and mortgage decisions for you and your family. If you've got questions or comments along the way, please call or text them to us. 855-462-7292 is the Anytime Hotline. That's 855-462-7292. Jen, my producer, is standing by, womaning the hotline. She's going to dig right in and get your questions on the air. If you prefer to shoot us an email, maybe you're a little shy and you'd rather type, no problem. Go to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions to her. That way she'll happily read them on the air for you. Hey guys, but wow, what another up and down seesaw week in real estate and mortgage and Federal Reserve and interest rate news. Man, another crazy week. We started Tuesday, I believe it was, with a positive note. There was a headline released in CNBC that said, mortgage applications surge as interest rates are off their highs. Well, all that data is at least a week old. I always get a chuckle out of that because if you're a listener to the show, you get access to the real-time data, which you can find on the Facebook page or any of those links at MrMortgageRadio.com. But anyway, the article was referencing last week interest rates pulled back a little bit to around 6 3/4. And we saw an uptick in mortgage applications. Well, by the time the article was published, we were back nearing 7%. So I find it interesting, though, and this has proven time and time again since the latter part of last year when we clipped the 7% interest rate and everybody put their foot on the brake and they were thinking, I'm not putting my foot in the water. It is no fun over there in the interest rate world. Well, guys, every time we seem to get a rate closer to the mid sixes, the activity picks back up. And for a minute there, we dipped down very close to 6. And we saw a surge of activity. And the reason I'm sharing that is if you are buying or selling, that seems to be the inflection point. That 6% interest rate seems to be where everybody has a tolerance for the cost of money. And I believe part of that is because we can use some of the interest rate buy-down strategies to get a 6.5% interest rate with a 3-2-1 buy-down all the way down to 3.5%. But with a permanent rate down, we certainly can get it into the low 5s. And I think that becomes an exciting interest rate to borrow money at again. So one more example of that threshold seeming to be what triggers activity. As rates pull back a little bit and we can use some of those buy downs, people are more interested in raising their hand and saying, hey, over here, I want to buy a house. So I don't know why I'm sharing that. I guess if you're buying and you're able to make it work in a higher interest rate environment with maybe some buy down strategies and some seller contributions, you might have less competition to deal with. And if you're selling and you see a slight downward trend on interest rates, it might be a great time to get maximum activity on your property. But anyway, I just wanted to share that because I do find that fascinating. And it's happened over and over again in the last several months that seems to be where everybody's got, they're not loving the rate, but they're tolerating the rate at that point. So I just wanted to throw that out there. And then let's talk about the big bad wolf, the Federal Reserve Chairman Powell. He huffed, he puffed, and he didn't raise rates this time. And it was interesting to see how the market reacted because I think for the most part, everyone believed there was going to be a pause as far as the rate hikes are concerned. And that proved to be the case, right? he, took his foot off the gas. But here's the thing, guys. The market turned negative on the comments made by the Fed that there are likely 2 more rate hikes coming this year, which was interesting to see because everyone thought, okay, here we go. We're at a point where inflation is easing and this is over. Well, guys, it's not over anytime soon. And what I mean by that, if you're still out there grocery shopping and buying gas, yeah, inflation is raising at a slower pace than it did last year, but there's still inflation out there. And guys, the data is released on a year-over-year data set. So when they're comparing March or April of 2023, April of 2023, most recent data set released, we were 4.9% year over year. Well, guys, in April of 22, we were 8.3% year over the previous year, which was 4.2%. So you can see that we're building on already rather large numbers. And slowing inflation doesn't mean deflation. It just means the race car is slowing down a little bit, but it's still going pretty darn fast out there in the left lane. I think everybody needs to get their mind around that because the headlines can be super confusing, especially when the market reacts in such a way as it did around the CPI numbers and the anticipation of the Fed not raising rates. There was a collective sigh of relief, but I don't think the pain is over yet. And here's a fun fact, guys. If you're curious why everyone is so very, very concerned with inflation and why this feels so very high, since January of 2012 through February of 2021, inflation was under 3% and often under 2%. And it wasn't until March of 2021 that we then broke past 2% again, and we haven't been close to that since March of 2021. We went from 2.6 to 4.2 to 5, all the way up to 9.1%, and we're slowing down. We're back down around 5%. But again, those numbers are year over year numbers. So the 5% or the 4.9% to be exact is on top of an already swollen number, which was already swollen compared to the year before. So yeah, we're seeing slower inflation, but we're still seeing inflation. And the Fed has indicated that they're not convinced this party is over yet. So I believe there is a little more interest rate pain to come in the future, which means using some of the creative strategies around buying property are more valuable than ever before. And we're going to dive into some of those. Hey guys, you hear the music? You know what that means? That means Jen is standing up in her chair, waving her arms at me saying, Mark, shut up. We've got to go into a break. Guys, we are going to run into a quick commercial break. On the other side of this break, we'll be back with more of the show, and we are going to dive into your questions. Sit tight.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned in to the Mr. Mortgage Show. And friends, thank you so much for spending a bit of your day with us. We always enjoy the interaction. If you've got questions or comments, just call or text 855-462-7292. That's 855-462-7292. Jen is womanning the Anytime Hotline, and she'll get you on the air. And don't forget, if your preference is email, just check out MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot her your questions that way. But guys, we were wrapping up my rambling dialogue about CPI numbers and how the headlines alone can be a bit deceiving unless you take them in context, right? So hopefully that helped. If anybody has questions and wants to deep dive that, let's talk about it. But I do want to share a story about how some people are still winning in this real estate environment. When I said that, I thought of that actor. What was that 80s actor? Tiger Blood, winning, Charlie Sheen, winning. Anyway, I don't know why my mind went there, but people are still winning in this environment. And I was blessed to be introduced to a gentleman this week who's buying a 7-unit apartment building. And man, oh man, he is getting a great deal. This thing is throwing off a lot of cash. But it's super interesting because he's another person that has equity in other properties, and he's able to pull some equity out of the other properties to get into the rental building with the landlord loan. So it's fascinating to me that some people just kind of turtle in and read the headlines and then just hide, right? They pull the covers over their heads. And other people read the headlines and then use that data to their advantage. You know, hey, Mr. Seller, interest rates are high. The buyer pool is cooling off considerably. I might be your best option. So, and I'm not suggesting deceive anybody, but if you're capable of making transactions happen right now, I think you may have an advantage in some markets in some instances. And another place we're seeing people take advantage of the market is buying that ugly property, right? The one that needs some work. And for first-time home buyers in particular, this is a really good option if you can qualify for one of the rehab loans, because oftentimes the first-time buyer can meet the down payment requirements, meet the payment thresholds to qualify to buy that fixer-upper, but then they're stuck. They don't have any money left for the repairs, you know, the HVAC system, the kitchen, the roof, whatever it is, because they used everything they could to get into that house. So using a rehab loan where you can roll those costs into the purchase of the property. FHA has one. All of the loan programs have a component that allows the rehab to be rolled into it. Now, not everybody qualifies, but it's available out there. So if you buy the ugliest house in the nicest neighborhood and use a rehab loan, and you may find yourself in an equity-rich position right out of the box. So I just like to touch on that because oftentimes people are looking for solutions when it seems that the deck is stacked against them. And there are a few places that we're seeing on a regular basis people use some of these strategies to win. So I just wanted to share that, but enough sharing, although sharing is caring, enough of that. Let's dive into your questions because that is what I care about. So I'm going to throw it over to Jen and see if okay, go ahead, Jen.
Amanda sent us a text. So every time rates jump, I know my buying power is reduced. Is there a rule of thumb of how much less I can qualify for with each 0.5% the rate changes?
Wow, that's a brilliant question. I'm a little embarrassed that I don't have the answer to that right off the tip of my tongue because there are so many variables in each qualification scenario, right? The taxes, the insurance, the association fees. So because there are so many variable ancillary expenses in buying a property that count in your debt to income ratio, there's not a hard and fast rule. But I will share this with you. I was speaking with an agent. He's in California, and a lot of the properties that he sells are over $1 million. And I think this is a good number because it's proportionate. We can just reduce it down to whatever loan amount that you're considering, because we were talking about a $1 million loan. And this is when rates, I don't know, a month or so ago, 3 weeks or so ago, jumped back near 7. And his question to me was, if I could afford $1 million at 6%, how much could I afford at 7% with the same principal and interest payment? And in that calculation, when we ran the numbers that day, it was just under $900,000. So, I mean, just under, like a couple thousand under. I don't remember exactly, 897.5 or something like that. But my point in sharing that is that in that instance, at the $1 million loan amount, which is a pretty good number to use to divide down from, there was a little over a 10% reduction in buying power at a full interest rate move. So I hope that helps. You know what I'll do, though, because this is such a brilliant question. I'm going to put together a calculation and I'll post it to the Mr. Mortgage Facebook page. And guys, if you want to check that out, go to mrmortgageradio.com and click on that Facebook icon. I post all of the data sets that we use each week when we're talking about these articles, and I reference some of these reports. I put them up there for everybody to review for themselves because I don't ever want you to take my word for it solely. Although I'm blessed if you do, this is all based on real data each week that we do the show. So I'll put that up there because I think it'll be helpful. But brilliant, brilliant question. And then we can determine it by quarter point, half point increments. So you can just plug in for yourself and see exactly how. Here's another thing that may help. If you go to the Mr. Mortgage website, which is linked to Mr. Mortgage Radio, there's an amazing loan calculator there that you can work backward from a payment. That might be helpful too, because the payment is the constant, guys. That's the thing that matters most. It doesn't matter what the rate is. It doesn't matter what the home price is. You qualify for a payment amount. So this was a really, really good question because the payment is the constant. The loan amount goes down as the interest rate goes up and vice versa. The lower the rate, the more you can borrow. But the number that doesn't change is the payment that you're qualified for. So man, I appreciate that question. And you have given me some homework and the answer will be published to the Facebook page. I love having smart listeners. That was great. Hey guys, you hear the music? You know what that means? That means I got to jump into a commercial break. That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, you're in the right place if you want the data, not the crazy headlines, but the real data, the tips, the tricks, the strategies, all the info that you need so you can make better real estate and mortgage decisions for you and your family. Hey, if you've got questions, and I know we've got some stacked up, so we are going to do a rapid round here in a minute. But if you have questions, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is standing by, womanning the hotline, and she will get your questions on the air. And as always, if your preference is email, just head over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. Click that email icon and you can shoot your questions over to her that way. Hey, but speaking of your questions, I know I went long in that last segment, so let's get caught up. Hey, Jen, are you ready? Okay, what do you have?
Tim sent this email. I found an 8-unit rental property and want to talk with you about the landlord loan. I'll call your office, but I'm wondering what the down payment requirement will be, so I know if it's something I can pursue.
Hey, Tim, that's a great question, and great job, my man, by taking that piece of the equation off the table before you go out there and start looking at property. So brilliant, brilliant question. Now, the answer is not cut and dry because all of the loan programs, right? But the landlord loan and investor loan programs in particular, the amount as a percentage, right? What we call the loan to value, the percentage of the value or the purchase price, which the bank is willing to lend, is the loan to value, LTV. That is determined in part by your credit score. So depending on your credit score, you may have to put 30% down. Now, if you have a higher credit score, and usually the threshold is around a 700 credit score, but they do have a tendency to move the goalposts from time to time. So I believe right now today, with over a 700 credit score, you could get away with as little as 25% down. With lower than a 700 credit score, you're going to be looking at 30% down and maybe even a little bit more depending on your credit score. Now, it's interesting because that's for an 8-unit. So a 5 to 8 unit landlord loan has a slightly different criteria and LTV thresholds and credit score thresholds than a 1 to 4. So it's interesting because logically it doesn't make a lot of sense why they would be different, other than I believe with the 1 to 4 unit, because of the fact that somebody could occupy that as a primary, it's probably less of a risk in the lender's eyes, because a 1 to 4 unit does also qualify for, primary residence type loan programs. But to answer your question, depending on your credit score, it could be as little as 25% down. Now, again, going back to a 1 to 4 unit landlord loan property, you could increase that loan to value a bit and have to put less money down. So brilliant question. I hope that helps. If you need more information, just reach out to us. I would be happy to have a conversation with you about that. Hey, Jen, throw me another question.
Courtney sent us this one. If we assume a seller's mortgage, can we take a second mortgage to cover the balance between their mortgage and say 90% of the value? We qualify for a 90% loan, but would prefer to assume their 2.99% rate.
Aha. Courtney, thank you. This is a fantastic question, and I'm so glad that you asked it, because I really want to take a minute to discuss how assumable mortgages work, because right now, that's a big buzzword running around out there, because so many people have, lifetime low interest rates, and selling a property with an assumable loan in a 3% interest rate category when rates now are creeping back around 7, man, your property is super sexy to a buyer. Now, here's the challenge, and Courtney, obviously you've discovered this. If you assume a loan as a buyer, you're assuming the loan balance, the interest rate, the payment, everything. You don't get to requalify for the loan at a higher loan amount and buy the property with that. You take that loan over exactly as it exists. And so many people have such a large amount of equity that the buyer is then responsible to bridge that gap, right? If you're buying a $300,000 house and it's got a $200,000 assumable, well, that $100,000 you've got to come up with. And a lot of people ask this question. Well, the answer is not cut and dry. In theory, right, it makes sense. And in theory, it's doable, but it's at the discretion of the lender who's executing the assumption. And that's not a new mortgage company. That's not a mortgage broker. That's not somebody on my team. That's not even the original bank. It's the servicer of the loan. So whoever the current seller is making the payments to, that's the servicer. That's who you contact to start the assumption process. And if you make that phone call, I would ask them, because in some instances they may allow it, assuming that the debt to income ratio still works, assuming that the CLTV, which is the combined loan to value, which takes the place of the loan to value requirements when you have any type of subordinate financing, second mortgage, HELOC, whatever it is, there's a CLTV component to it. So it's not a cut and dry answer, because it's not a cut and dry circumstance. But the very first phone call that you want to make is to the seller's servicer, so you can start the process of assumption, and then ask them how they work a second mortgage or an equity line or a seller second into the equation, if they even will. I've not seen a lot of people successfully pull that off. We get asked about assumptions all the time, and I'm happy to help and guide people, but there's only so far we can go, because we can't execute an assumption. The only company that can facilitate that process is the current servicer. So brilliant question. Call me off the air if you start the process and you've got some technical questions. And I'd be curious to know how you make out if they are willing to give you a second mortgage to bridge that gap. Brilliant question. Hey, Jen, let's squeeze in another one. What do you have?
Clint is asking, I own a vacant lot and think I'm ready to build a house. Can I get a construction loan as an owner-builder? If I can't and hire a GC, who pays the loan during construction?
Hey, Clint, that's a great question, my man. So, yes, you can do a construction perm loan as an owner builder, but there are definitely some requirements that have to be met. approved builder. It's helpful if you've had some past experience, or at very least, you might have to hire a GC as a consultant to help you manage the build. But there are loan programs for construction to perm, owner builder. And guys, construction to perm just basically means the construction loan converts to a mortgage at the end of the construction period. So that's the perm part. You'll hear that often, and it confuses the heck out of a lot of people. And then the second part of your question was who makes the payments? Here's the beautiful part about the construction perm. Nobody, interest reserves, right? So they take, during the construction period, only interest is due on the property, and they'll loan you that as part of the construction loan. So the loan essentially services itself in the beginning, and no payments are due until you close and convert. So brilliant question. If anybody needs more info, reach out. But guys, you hear the music, you know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you heard the man, 855-462-7292. That's the Anytime Hotline, 855-462-7292. Call or text that number, and Jen will get your questions on the air. 855-462-7292, or check out MrMortgageRadio.com, MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. But hey, I know we've got some stacked up because I've been windy like the Windy City today. And man, I'm having a blast. Great questions to start the show off. You guys are bringing it today, and I love it. Hey, Jen, throw me another question, would you?
Stephanie sent us this. My parents left me a fourplex about 5 years ago. There is no mortgage now, but I'd like to do a cash out and buy the fourplex next door. Will this work with the landlord loan? I don't live there. They are all rentals.
Hey, Stephanie, that's a great question. And wow, what an awesome thing for your folks to leave you. Man, that's amazing. Guys, that's the power of real estate, right? Her folks were smart enough to buy an investment property. And I don't know the story. I have no idea, but I can just imagine that they benefited from all the rental income over their lives. They paid it off. They owe nothing, and they get to leave that to their daughter. Wow. Instead of a bunch of cash, they left her an income stream because, guys, we talk about it all the time. Equity doesn't put gas in the tank, but cash flow does. And brilliant question and brilliant scenario. I love to hear these type of stories because that's how we create generational wealth and stability. The easiest way to do it is with real estate, right? Because you don't have to save any money and sock it away into investments. You're just substituting a rent payment for a mortgage payment, and then you pull some equity out and you use something like the landlord loan, which is what this question is about, and I promise I'm getting to an answer, to go buy other properties with it. And now you've got 2 properties or 3 properties building equity. And then ultimately you might be in the position to leave your kids some free and clear rental property. So brilliant. But anyway, I didn't mean to get long-winded. I just think a lot of people overlook the power of equity and principal reduction and self-liquidating debt with rental property. But anyway, to answer your question, yes, absolutely. You could do a landlord loan on the existing fourplex to pull the cash out to then go buy another fourplex. And if anybody is wondering how many of those landlord loans you could typically have on your portfolio before scrutiny, that number is 30 loans. I mean, that you could own 30 properties with the landlord loans before you have to start going a different direction. So brilliant question, and congratulations. If you need any help with that, we'd love to be a part of your journey. Great job. Hey, Jen, throw me another question.
Danny wants to know. I co-signed for each of my daughter's car loans. They're both paid on time, but I know there is a waiting period or something before those loans won't hurt my credit. How long is that before I can apply for a mortgage?
Hey, Danny, that's a great question. And you're a good dad, or your daughters have you wrapped around their fingers. I don't know, maybe a combination. I'm glad they're paying them on time because that's super, super important. But I think where you're going with this is 12 months of history of someone else making that payment, right? So 12 months of your daughter's bank statements showing that she's making the car payment. Then we don't have to count that payment against you in your debt to income calculation. Before 12 months, then it's going to count against you because they haven't established themselves as the person who makes that payment regularly, and the underwriting guidelines have established that 12 months is that time period. So you will want to keep them close for 12 months and make sure they're making those payments on time. But brilliant question. And I'm glad you asked that because a lot of people don't realize that when they co-sign debt for a friend or family member or child, that you're now married to that debt on your credit report. And even though they're making the payments on time, if it's less than 12 months, that's still going to be thrown on your side of the debt to income calculation. After 12 months with verification of them paying it, then you're in good shape. So brilliant question. I hope that helps. If you need me to elaborate on that, or if anybody else has questions about that, just give us a shout. I'll be happy to have a discussion with you. Hey, Jen, do you have another question ready? Okay, go ahead.
Anita sent us this one. I saw a Facebook post where you talked about claiming rental income on my taxes so I can qualify for another mortgage. I thought the landlord loan doesn't verify my income. Am I missing something? Thanks. You guys are awesome.
Hey.
Aw, thank you, Anita.
Yeah, thanks, Anita. Clearly that should have been a longer post, right? But it's hard to squeeze a bunch of information into a 1-minute reel. And this old dog is doing his best to learn social media. So, Anita, thank you so much for checking out the Facebook page or the YouTube. I don't know where you saw it, but all of that stuff is at Mr. Mortgage Radio if anybody out there is curious. But what I was talking about in that is not the landlord loan, because you are absolutely correct. You're not missing anything. If you use the landlord loan to buy a rental property, we're not looking at your income. We're looking at your credit. So if you've got multiple mortgages on your credit, you want to make sure they're all paid on time, but we're not looking at your income. What I was talking about in that video that you're referencing is, let's say, for example, that you've got your current home and you want to go buy another home, right? And you're going to rent your current home out. Well, right now, the guidelines only require you to have a deposit and a lease in hand. And then we don't have to calculate that debt on the current house against you when you buy the new property, assuming that the rent covers the mortgage payment 1.25 times, right? So we got that out of the way. You've got a house you're keeping and you're going to buy another house. Here's where the challenge comes in. If the current house that's now rented, if you're not claiming that income on your tax returns, if you try to duplicate that strategy in the future, or if you go to refinance the new house, you're one of many people who believe rates are going to fall, and let's say they do, and then you try to refi that property. If you're not claiming the income from that first rental property on your tax returns, then both mortgage payments are going to be used in your debt to income calculation. And that was the spirit of that video, is because a lot of people assume, because they're not making a profit, right? In their minds, they're breaking even on the rent, so there's no income to claim. Well, guys, in the IRS's mind and in the world of mortgage underwriting, because I say it all the time, if you don't show the IRS, you can't show the mortgage guy. All rental income is income. Now, it might be offset by a ton of expenses, depreciation, the whole 9 yards, so no income taxes due. You may even be able to claim a loss, but you definitely want to claim that income for this very scenario that we just used as an example, because if you're buying a primary residence or you're refining a primary residence, income documentation is going to be required. And that's what I was talking about, holding on to your current primary while you go out and buy a new primary and you're renting that first house. make sure you claim that income. Now, guys, you don't have to make a profit. You don't have to pay income tax if you're not making a profit, but take the time to file those schedules because it will come back to bite you in the rear end. And that video that I made, I was referencing a gentleman who was on property number 3 when all of that caught up with him because he claims none of it on his tax returns. And we could not do the rec refinance on property number 3 because we had to calculate all of that debt against him. So, but I hope that helps. And I want to thank you again for diving deep in the Facebook videos because I have a lot of fun doing them. And clearly, you were paying attention. So good job on you for that. But thank you for that. Great job, Anita. Thanks for calling me out on that. I'm sorry I confused you, but I'm glad I had an opportunity to explain it. Guys, there are so many nuances in mortgage underwriting and which program sometimes makes more sense than others, whether it's down payment assistance, whether it's getting your credit report rescored because the difference between a 694 and a 701 might change your program options significantly. We talked about that earlier in the show with the landlord loan and how much you could borrow on an 8-unit property with the variables in your credit score. So guys, I always appreciate the opportunity to answer questions. And if you need more information, regardless of the topic that we cover, feel free to reach out. We're always here and happy to help. But guys, I've been rambling. You hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be right back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you heard the man, 855-462-7292. That's how you join all the fun here on the air. That's the Anytime Hotline. Call or text that number, 855-462-7292. And guys, write that number down. We call it the Anytime Hotline because it rings here in the studio when we're doing the show, but then that forwards to my office for the rest of the week. So 855-462-7292 is the easiest way to get us. You can call or text that number anytime. And I mention it all the time. If your preference is email, check out MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over to Jen, and she will do the rest. But hey, speaking of Jen and speaking of your questions, I know we've got a few more to get through. So, hey, Jen, do you have another one ready? Okay, go ahead.
Holly sent us an email. We've read through the reverse mortgage booklet you sent us. Thank you. I have a question, though. How do we know if the Lisa account is required? I'm not clear on how this will work.
Hey, Holly, that is a brilliant question. And we have just established one more time that we've got the very best listeners in all of mortgage and real. You know what? In all of finance-related talk radio. That is a brilliant question because clearly, and first let me say thank you. Thank you for requesting the booklet. Then thanks again for reading it because clearly you did a deep dive if you're asking about Lisa. So, and guys, Lisa's not my sister or my cousin or my ex. Lisa, L-E-S-A, stands for Life Expectancy Set-Aside Account. And what that Lisa account is designed for is in the circumstances where the borrower has not demonstrated the ability to manage their finances, a portion of that equity is placed into that set-aside account so that it takes care of your taxes and your insurance and if there are any homeowners association dues. So, Holly, the only way I can answer that question is to, go through the process with you and take a look and see if you would be required based on your credit history and your payment history of things like taxes and insurance. And it's not often required, but it is a wonderful tool in the situations where, somebody's just struggling. Maybe it's for medical reasons. Maybe they're just bad at managing their debt and they forget to pay their taxes. They forget to pay their insurance. So just so you know, in a foreclosure scenario, the government gets paid first. So taxes, municipal liens, all that stuff gets paid first before the mortgage. So the mortgage lender wants to make sure that that's paid. And then in the instance of insurance, God forbid there's a fire and your house burns down, the insurance company would make sure that the mortgage company's paid in full, and then you would get the difference, or they would rebuild the structure. So there's collateral there, there's an asset. So insurance and taxes being paid on time is super important, and that LISA account is designed for circumstances where people have demonstrated either the inability or the unwillingness to manage that debt, then they'll take care of it for them. So it's good in the sense that if you have no other choice and you've got to do this because you're just overwhelmed and you can't make payments anymore, it's truly set it and forget it, even in the instance of taxes and insurance. But it's not required that often. It really comes down to your past history with making payments. And part of that's going to be based on your credit report, and the other part is based on taxes and insurance. And you hear me say it often that the reverse mortgage itself isn't based on income and credit, but this is an instance where the credit is evaluated, because the term that we use in the industry is the ability and willingness to manage the debt. So I hope that helps. Let's have a conversation off the air, because you've clearly started seriously looking into this, and I'm sure there are other questions. So I'm happy to jump on the phone with you, but I appreciate that question. Hey, Jen, let's squeeze in a couple more. What do you have?
This one is from Ricardo. If I go in partners on a house with my cousin and one of us wants out later, how hard will it be to refinance each other out of the property? How does that work?
Hey, Ricardo, that's a brilliant question. And that's another thing we're seeing a lot of right now are friends and family members who are buying properties together because of the cost. You know, they're just not qualifying on their own. But great job looking to the worst case scenario, because too many people go down this path, and it's usually boyfriend, girlfriend. And they say, okay, we're going to split up, just quit claim deed me off the property and you take over the mortgage. Well, that's great for the person who is remaining on the deed, but bad for the person who is still on the mortgage with them, because God forbid they stop paying. You're going into foreclosure too if you're the one that deeded yourself off the property. And we talked about it a little bit earlier in the show. You would have to wait 12 months and then show that the other person has made those 12 payments before that debt's not counted against you. So the right way to do it, Ricardo, is exactly how you asked it. It's a refinance where one person is buying the other person out at the closing, and then the loan and the property is solely in the name of the person who is remaining in ownership of the property. Guys, I say it all the time. If you're not going to own the asset, don't own the debt. So if somebody's talking to you about quit claim deeding yourself off the property and they're going to take it over for you, that's not well, I was going to say not ever, but I can't imagine a situation where that makes a lot of sense. Unless you're going away to prison for something and you don't have a choice. But anyway, great question. I hope that helps, and I welcome the opportunity to deep dive it if you need us to. Hey, Jen, throw me another question.
Marlene sent an email. Is the landlord loan an option for a commercial office building? It's fully leased and should cash flow with no problems.
Hey, Marlene, brilliant question. However, the landlord loan is designed for residential properties. Commercial office buildings, strip malls, anything storefront, that's a whole different animal. We can certainly help, but that's going to be a commercial loan program. And it may even be SBA eligible, which is awesome, because there are some 90% loan to value SBA real estate loans. There's some amazing loan programs out there. So I welcome the opportunity to dive a little deeper. But to answer your question, no. The landlord loan in and of itself is designed for residential income producing properties. And by that, it could be an apartment building, but it's where people sleep at night. So great question. Hey, Jen, do you have another one?
Nicole sent us this text. Is a mortgage for a mobile home the same as a regular house? My dad says it's more like a recreational vehicle loan. I'm not sure what that means.
Hey, that's another great question. We are going fast now. So a mortgage on a mobile home or manufactured home is the same as any other mortgage if you own the land as well, because then it's deeded as real property. What your dad's probably referring to is if you lease the dirt, but you own the structure, and then it's a different loan program. I guess you could consider it kind of like a recreational vehicle loan, because they're, usually around 20 years, slightly higher interest rate. But man, some of those big RVs are a couple $1 million. So I'm sure it feels like a mortgage. But if you own the dirt underneath the mobile home, then a regular mortgage is most likely going to be available. There are age restrictions and a few other nuances, although there are some programs that don't even have age requirements anymore. So I hope that helps. Hey, Jen, let's squeeze in one more.
Phil is asking, I'm 78 years old and want to sell my house and downsize. I don't have much income, but I will have a nice amount of equity when I sell. I don't want to spend all the cash on the next home, and I don't really want another mortgage. What are my options? I do have good credit scores.
Hey, that was Phil? Okay, Phil, I definitely need more time than I have, but where my mind instantly went when Jen read that question was a reverse mortgage for purchase. And very few people even know that exists. Check out MrMortgageRadio.com, click on that More About Reverse button, and I'll send you a package. But you can use a reverse mortgage for a purchase of a property and never have to make a monthly mortgage payment. So assuming that you cash enough equity out of your current home, and you mentioned downsizing, so I'm guessing you're going to buy a lesser expensive property, it's a really cool strategy. You put some money in the bank, you put a big down payment down on the house, you never have a monthly mortgage payment, and you end up living more comfortably because of that. So brilliant question. I'd love to talk to you more about it. Anybody who has reverse mortgage questions. Oh my gosh, you hear the music? Man, oh man, Jen, this was a fast hour. Wow. Guys, I love spending a little bit of time with you each week on the air, but you know what that means? We've wrapped up another week here at the Mr. Mortgage Show. If you need us during the week, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. All my contact info is there. Links to all the good stuff we talk about on the air. Everything can be found at MrMortgageRadio.com. But guys, we are going to pack up and head out of here. Have an amazing week. We will see you next time right here. Same bat time, same bat station.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.